Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you minimize your losses and keep more of your profits through our proprietary market signals that are emailed to you every weekend for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Friday, March 20th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. We were down 4.34% today on the S&P 500, and we closed at 2304.92. That is the lowest close that we have seen in this downturn so far. This blue line is the 2350 level that I've been talking about, and this chart is just today. So this is a 1 day, 1 minute chart. Each candlestick represents 1 minute of trading in the S&P 500, and you can see that we closed at the lows of the session, or right at the lows of the session, so not a bullish sign at all. And you can see there was tremendous amount of volatility for the day. The dotted blue line is where we closed yesterday, so we did open up slightly positive, went negative, went positive, and then about 11:20 we went negative, and we then just backslid all the rest of the day, closing right at the lows of the session. And again, down 4.34% for just today. Now, when we pull back and look at a longer-term chart, now this is a 1-year chart where each candlestick represents 1 day of trading in the S&P 500. Again, the blue line represents the 2350 level on the S&P 500. And for those of you that have been following my work, you know that I've been talking about this level for a long time. This is a critical support level that we broke today. And you can see that this is the first close during this whole correction, this whole bear market now that we have. This is the first time that we've closed beneath 2350. So we had, for the last few days, we've dipped below it and tested the 2350 level. But today, this is the first day that we've closed beneath that level. Now, when we pull back to an even longer-term chart, this is a 7-year chart where each candlestick represents 1 week of trading on the S&P 500. You can see for the week that we're down about 15% for the week on the S&P 500. My understanding, this makes this the worst week in the markets since 2008. So this is a very serious situation here, guys. And again, the 2350 level did have some support. We can see that this is where we started this rally, where we bottomed at the end of 2018, bounced off of that 2350 level, rallied, and of course peaked at 3386.15, which is the highest close ever on the S&P 500. That was back on February 19th. And you can see that we took the stairs up, and boy, we took the express elevator down, now closing below 2350 for the first time really since, as you can see here, back in about March, April of 2017. So now that we're below this level, those of you that have been watching my videos know that I've been talking about this 2000 level on the S&P 500. And this, of course, I believe will be the next level that we're going to hit. So once we hit this 2100 level, we should start to slow down the rate of descent, I believe, based on the technicals, because there's a lot of trading in between 1900, which is this lower blue line, and 2100, which is the upper blue line, with 2000 being the midpoint. And you can see the first time we ever got above 1900 on the S&P 500 was back about mid-2014. And then we traded between 1900 and 2100 roughly between mid-2014 and mid-2016. So we have roughly 2 years of trading in this range. So this area, 2000 plus or minus 100 to 125 points, should provide a lot of technical support. Let's keep our fingers crossed that it does, and let's keep our fingers crossed that that's as bad as it gets. However, guys, do not discount how dangerous these markets are. And personally, for your own health and safety, please don't underestimate the seriousness of this coronavirus. Don't take this thing lightly, guys. Don't take it lightly personally for your health, and don't take it lightly in the markets either. This is a very serious situation. And of course, it's not just about the coronavirus. We're also dealing with the oil markets, which popped a little bit yesterday, but I understand we had a pullback in oil again today. So that's a whole nother set of problems out there that are going to exacerbate what's going on in the global marketplace. And then we've had problems with the bond market. So this is a perfect storm, okay? And by the way, this is going to be a two-part session tonight. So part 2 will be titled Perfect Storm. And so you'll want to watch that video as well, and that will give you more context around what's been going on, but also some things that I can do to help you through my business, Simple Market Signal. So I would encourage you to watch both videos for tonight, or at least over the weekend, because you're going to learn a lot, and it's really going to help you. Now, let's move on to talk about some of the diversifiers, and let's go back to a intraday chart, and you can see here again on the S&P 500 that we were down 4.37% just for today, and the gold miners were down. The large caps were down 3.39%, the small caps down 4.49%. Gold and the treasuries actually had a better day today. They haven't been working very well for us as diversifiers for your portfolios. Those of you that have a 60-40, 70-30 type portfolio. These things just haven't worked that well as of late, but they did help today. The longer-term bonds, the TLT, which tracks 20-plus year duration treasuries, was up 7.52% today. Nice pop in that. And then the IEF, the 7 to 10-year treasury ETF, was up 2.55% today. So treasuries definitely did act better today than they have for the last few days. And then gold, as tracked by the GLD, the ETF that tracks gold, was up 1.5%. So again, a little bit better trading action here in these diversifiers for equities than what we have seen over the last few days. When we pull back and look at these same things over the last week, you can see the S&P 500 again is down about 15% for the week. The large cap gold miners are up 8.16. The small caps up 11.23. Gold itself, tracked by the GLD, is down 2.21% for the week. And the treasuries, the 7 to 10-year treasury ETF up 1.53%. And then the 20-year treasury bond ETF up 3.57. So these things, at least for the week now, are starting to act a little bit better. Earlier in the week, those things weren't looking so good. And then you can see for the month, and you can see here that we were down 31.69% this month in the S&P 500. So a very brutal month, and it puts us right at, today's 320, right? So 319 is where we peak. So today, this really marks the month from the whole month where we started to turn down from where we peaked. So you can see it's been an absolute brutal month. We've set some records for the fastest correction ever, the fastest bear market ever from a peak in the markets. Not records we want to set, but again, it speaks to the volatility and also the liquidity in these markets where, and again, you need to memorize this saying because the markets, and going forward, guys, I don't think it's going to change. I think it's going to be this way or worse. The markets are going to take the stairs up and the elevator down, and as I just kind of coined the phrase, the express elevator down. Just understand that's probably the new norm. We'll talk more about the new normal in part 2, the video that I've already got prepared for you guys for tonight. So make sure you watch part 2 of this two-part series for tonight. Make sure you watch both parts because it'll be very, very educational. But again, you can see here why you want to stay away from miners. So, when it comes to equities, guys, the gold miners, they're going to act just like stocks when things go down, okay? So, and you can see that here. The large cap gold miners were down 30.92%, so almost exactly what the S&P 500 was down this past month. And you can see the small cap, the junior miners, were down 43.65% for the month. So, ouch. These things, again, just memorize this. They are not diversifiers for your equity portfolio. And even gold, tracked by the GLD, yeah, it was down less, but it was still down 8% for the month. And then you can see here that the treasuries helped out a little bit, up 4.83% on the 7 to 10-year treasury bond ETF, and up 8.86% on the longer duration, the 20-year duration TLT, the ETF that tracks that longer duration treasury bond area. Guys, be careful out there. It's definitely, in my opinion, the markets are going to go down more before we find a bottom here. Don't try to catch this falling knife. And please, for your own benefit, look further into Simple Market Signals if you haven't already subscribed. Guys, it's less than $20 a month, and it will really help you not only in these types of markets, but Simple Market Signals helps investors in both up and down markets. Simple Market Signals is like Risk Radar for the U.S. stock market. So if you haven't already done so, subscribe. It's less than $20 a month. Your first 2 weeks are free. There's no contracts. You can cancel anytime. And it's really going to help you. But I will tee up some more information, some other videos that you can watch if you so desire. Thank you, and have a fantastic weekend. Now, let me give you a really quick overview of what Simple Market Signals can do for you. How would you have liked to had a clear signal to get out of the market back in 2000, right here at around the 1450 level on the S&P 500, and then stay out of the market for the bulk of the downturn, and then have a clear signal to re-enter the market right here, which is around that 900 level on the S&P 500 in 2003. So again, you could have had a clear signal to get out there at around 1450. You'd have been out of the market for the bulk of this downturn, re-enter the market right around here at 900. That's back in 2000 through 03. Now, let's go to 2007 through 2009. Same thing. Clear signal to get out of the market back in 2007 at around the 1500 level. You would have been able to get back in the market, clear signal given right here at around 875 on the S&P 500, and you would have missed the bulk of this downturn, okay? Now, let's fast forward to 2018. I'm just giving you a quick overview of how this works, guys, and what you're missing by not being a subscriber, all right? 2018, another real bad year in the markets. You could have been invested in these green periods, okay? The way I do it and the way I designed it for myself, I'm invested on the green periods. I'm in cash during the yellows and reds. So let's just look at these two green periods. You could have been invested here, got out right here, set out this period, and then you could have got back in here and been invested during this time frame, got out here. The market was negative, almost 5%, including the dividends being reinvested back in 2018, and you could have had a profit using Simple Market Signals by only being invested about 4.5 months of the year, okay? So that's just a real quick overview of what Simple Market Signals can do for you guys. So please take a deeper dive and take a look at some of the videos that I'm going to queue up for you here in just a second. All right, so now we're obviously out of my YouTube channel, the Rodney E. Constable Success Channel, and a few of the videos that you're going to want to watch if you want to find out more about Simple Market Signals. If you want to spend more time just on the charts like I just showed you, you can dig into these videos here. So the S&P 500 2000 through 03 using Simple Market Signals. That'll walk you through some of those charts and drill down a little bit further on what I just showed you. 2007 through 09 time frame, same thing. S&P 500 07 through 09 using Simple Market Signals. And then 2018 using Simple Market Signals. So it just gives you a little bit more context around those charts I just showed you. If you want to learn even more and you want a more in-depth explanation, introducing Simple Market Signals, which is about a half-an-hour video that digs into the system itself. So that is a really good video, about a half an hour. And then if you want the whole story, including my background, and you want a ton of great information, and you want the whole story, the Successful Investor webinar, which is about an hour long. Guys, you really need to invest some time in understanding how powerful this system is, okay? I developed it for myself. I'm sharing it with you for less than $20 a month. And I'm telling you guys, it works. So go out to the YouTube channel, check out these videos. I will also leave a link to those videos in the description box below this video. And I will also leave a link to the video of my financial services background. So if anybody's curious about my background and why you may or may not want to listen to me, this gets into my background in financial services, which is pretty extensive, including all my trading and everything. So that will also be in the description box below this video. And of course, if you haven't already done so, please subscribe to my YouTube channel. Give me a thumbs up on this video, and I will see you in the next video.